Hi, it's Professor Mike, and we're going to talk about Chapter 14, Audit of the Sales and Collection Cycle. A couple notes before we get into this. The next several chapters are going to be about auditing sales, collections, and accounts receivable. Um, One thing the textbook does not do a good job of is actually revenue recognition testing. They focus more on accounts receivable balances and transaction flows. I will talk about revenue recognition and revenue recognition testing as we go through this. In addition, we have a separate lecture on revenue recognition that we'll talk about in class. So there are five classes of transactions in the sales and collection cycle. Obviously, sales, right? Cash sales, for the most part, in the things that you're going to do, are going to be minimal to zero. More transactions are being conducted online for safety reasons, and there's just few less cash being transacted. So the types of businesses that would have cash sales are probably not the types of businesses that are going to have audits done. And if they are, cash is probably a smaller and smaller percentage of their transactions. So if you go to a big retail store like Walmart or Target or something like that, um, their cash transaction volume is going to be significantly lower. The cash volume in each store is going to be relatively low. And you're probably not going to be auditing the cash transactions at those stores. You're not going to go to a restaurant and do cash audits in most cases. So I'm going to focus mostly on transactions that are larger in scale and are not necessarily subscription. Because subscription accounting is basically revenue recognition. If you think about it, you don't get to uh, use Netflix and pay them in arrears. You have to pay them in advance to use Netflix. And so the chances that you're going to have accounts receivable are relatively small. In fact, if you look at Apple's financial statements, Apple has extremely small accounts receivable balance. I mean, it is in the billions, but it is less than 1 day's worth of sales for them. Um, you go into an Apple store, you got to pay either cash, check, credit card, whatever. And if you are paying on a monthly basis, you're probably paying that through some type of other credit facility where Apple gets paid up front. So these are the things to think about when you're dealing with the transactions that flow through the sales cycle. Um, Sales returns and allowances, there's a couple things in there that I'll go deeper on that are not in the textbook. Those are related to different types of charges that may reduce your sales dollars or may reduce your accounts receivable balance. Okay? And then finally, on bad debt expense, one of the presumptions in the new revenue recognition standard is that accounts receivable are collectible. So I'm going to spend time on emphasizing the importance of doing credit checks and documenting the collectability of accounts receivable, because that's a presumption in the new revenue recognition standard. So you can see the T account flows. Obviously, the flows into accounts receivable come from sales. The flows out of accounts receivable come from either cash collections, accounts receivable write-offs, sales returns and allowances, or discounts. And then those obviously affect other um, accounts in the income statement, which can include bad debt expense. It could include sales returns and allowances, which is a contra revenue item, things like that. So if you structurally think about stuff in terms of T accounts, this is a good diagram for you. So as I stated before, really the sales cycle starts with lead generation, which is going to be something outside of the accounting system. And what you want to understand is how leads are generated all the way through the sales cycle. So you can tell whether people are trying to accelerate sales uh, unnaturally through the sales cycle. This is something that's really important at year end for big transactions, you can tell whether things are going faster than they historically would, um, based on the concessions or other things being given to customers in order to close deals. Now, typically, what you see in things like enterprise software, big deal uh, situations, is there's a big emphasis to close stuff at the end of the quarter. So the fact that there are large transactions that close quickly at the end of the quarter is not necessarily unusual, but what you want to do is understand whether there were unnatural things that were done in order to incent the customer to close a transaction. You see some of this in the textbook, where there are bill and hold transactions, where there are rights to return, side letters done, extensive discounts or credits against future earnings, things like that. So those those are the types of things you look for outside of the accounting system. Once you get to the accounting system, you should have a customer order, some form of agreement between the customer and uh, you, the client, is presuming that it carries a quantity, a sales price, terms and conditions for the sale, the items that are being purchased, whether goods or services. This classification is important as well. You should have some documentation of credit. Um, you should have documentation that you actually delivered the product or service. And then you should have invoicing that shows that you invoice the client, and then they paid. So those are the documents in the cycle. The functions are really, cash receipts, sales returns and allowances, and then allowance for doubtful accounts and bad debts. Those are the other pieces of the cycle. So there's different classes of transactions. I'm not going to go through all these, but we've talked about how these fit into T accounts. And this is a different illustration, so you can see the business functions and the documents and records that are associated with each of these. So what you do when you're deciding how to audit sales and accounts receivable is you understand the internal controls first. A lot of times in a sales function, it's not going to be a small number of large transactions. It's probably going to be a large number of smaller transactions. And so you will need to make sure that you have some level of internal control testing incorporated in your test work so that you can reduce your sample sizes when you go to do things like accounts receivable confirmations. So how do you design the test of controls and the substantive tests for the transactions? You want to understand first how the controls work. Do you have adequate separation of duties? The person who invoices a customer is not the person who ships the goods, is not the person who records cash receipts. Do you have proper authorization? Authorization that the customer is creditworthy, for example. Pre-numbered documents, not really as appropriate anymore since most of this transaction volume is going to be computerized. Monthly statements are also not necessarily as relevant since most customers will pay based on invoice rather than statement. But if monthly statements are part of the business flow, then you should test monthly statements and be aware of monthly statements. It's all about how customers pay the client. And ultimately, once we get into the confirmation process, what's the easiest for the customer to confirm when you're sending out confirmation? And what kind of internal verification procedures does the company have? So we assess the control risk and figure out how much testing of controls we're going to do, and identify whether there are any deficiencies in controls, right? We don't want to test controls if there are significant deficiencies because we know we're going to find errors, and if the testing of controls doesn't provide us a benefit, then unless we're required to under the auditing standards for public companies who are over a certain size, then we don't test the controls. Remember, testing controls is designed to either give us an opinion on the internal control framework for accelerated filers, those large public companies, or in the case of non-accelerated filers or private companies, testing internal controls is only there for us to reduce our substantive work. So if we're not going to be able to take credit for it, we don't do it. It's an efficiency and cost question. So if we do have key controls that we want to test, we must test them to verify their effectiveness. We can't just document them and accept them as working. That's one of the things that you see in PCAOB reports, is that there was inadequate testing of internal controls, which then led the auditor to inappropriately reduce their substantive test work. And then substantive test work is based on transaction-related objectives. Again, you're looking at your CEA VOP. What are the objectives of the test? Is it to establish that accounts receivable were existing, that sales transactions were proper and recorded in the proper period, right? Accuracy. And then the transactions for sales have to be really tailored to the specific audit client, because you can't just generalize and say verify sales. Well, what does that mean? For Oracle, for example, they sell subscription software services, but they also sell enterprise software, right? Big deals where you go and you install that software on your own servers. You pay Oracle for maintenance, and you may pay Oracle to do the installation itself. So you'll have three different types of revenue for that particular side. For the software as a service side, you'll have a monthly subscription. Two completely different revenue types, two ways of auditing those revenue types, just within one company. So what direction do you test? This is very important. When you're testing for assets and you're testing for whether there's existence, you want to test from the accounting records to the source documents, because you're testing to make sure that the items that are recorded in the general ledger do in fact exist. So, if you're observing a physical inventory, you take the list of items that are in the physical inventory register, which ties to a general ledger, and you go find them in the client's warehouse. If you're confirming accounts receivable, you take something from that list and you send a confirmation out to the customer. And if you don't get a confirmation back from the customer, you go and look for the invoice, the shipping document, a customer order evidencing they want the stuff, and any cash receipts that have been there. Conversely, when we're talking about things like accounts payable and things, you're looking for stuff that's not there. So you actually go from source documents to the general ledger to make sure that those obligations were in fact recorded. Okay? So sales returns and allowances, you're really looking at credit memos. So this is where you're tracing from source documents back to the general ledger, because returns are a reduction of an asset. So they're like a liability. So your risk is that they're understated, and therefore you need to trace from source documents back to the general ledger. So a lot of times sales returns and allowances are immaterial, but in a lot of retail segments, in a lot of things that deal with consumer goods, they're not. For example, a company like Zappos, right, which is ultimately bought by Amazon, but when it was existing back in the day, it still exists, but when it was independent back in the day, they would accept a very high level of returns because they were creating a new market. When you look at a company like Casper, the mattress company, they have a fairly high level of returns and concessions, and therefore sales returns and allowances is material to them because it's part of their business. It's an acceptable part of doing business for them. The transaction-related audit objectives for credit memos are those for processing sales, except your objective is different, right? You should have relatively the same transaction flows in the reverse for sales returns and allowances. So how do you design tests for controls and tests of transactions for cash receipts? You look at you use the same methodology for sales, right? So you look at internal controls, you look at the control risk, and then you design the test for monetary misstatements, right? Again, cash receipts reduce accounts receivable, but they increase cash. So from a total asset standpoint, it should be a push. This one is usually a lot less risky unless there's fraud involved where somebody's misappropriating cash receipts, right? So the key here is if you received it, it was recorded. You want to understand the tests through accounts receivable. So if a customer says that in a confirmation that accounts receivable was paid, you want to go look for the cash receipt, or you want to get information about the cash receipt from that customer, and then trace it back through the accounting records. Okay. Primary concern on allowance for doubtful accounts or uncollectible accounts is not so much embezzlement in my mind. It's that maybe the sales process was really not complete when the client recorded the revenue. What you'll see in a lot of fraud situations is that accounts receivable were written off or adjusted. And what you're looking for is a history of concessions or other adjustments in those accounts receivable balances that may indicate that revenue recognition was inappropriately accelerated. That is the situation that you face in software companies. It's less that somebody's embezzling money, although that is a possibility. So when you're looking at write-offs, you're looking for a number of different things. Okay, the way that you control write-offs and assess the controls over write-offs is when people look at the accounts receivable aging, right? You look at invoices, you look at the dates of invoices, and you look at what is in the current column versus the 31 to 60 versus the 61 to 90 and over 90-day column, and see if those historical trends are holding together. There are seasonality considerations. There are types of business considerations. You may have businesses like the film industry and stuff that tend to pay as late as possible, right? So it may not be necessarily bad that you don't have a lot the 0 into 1 to 30 column, right? It may be that you're dealing with a bunch of big companies who want to stretch out their vendors and usually pay within 45 days, and you don't have leverage over them, and therefore most of your accounts receivable balance will be in the 45-day category historically. If it starts to slip to 90 or past 90, then that's an indication maybe of a problem, or maybe that the accounts receivable weren't really legitimate, or that they were accelerated, or that there were side agreements saying you don't have to pay this until you've sold it through, right? So there's a bunch of different things in the allowance for doubtful accounts and again in sales returns and allowances that could indicate revenue recognition problems, okay? So the results of these tests really impact the rest of the audit, right? Because when you do this test work, test of controls, substantive test of details, this reduces or increases your other balance test work, right? Remember the audit risk model. And then you break the audit risk model and detection risk to substantive test of details and then analytical procedures and test of balances, right? If they're unsatisfactory, we're going to have to do more test work, right? So we make a planned assessment, we verify whether that planned assessment is consistent, and if it's not consistent, we go ahead and expand our substantive test work. The the What happens in the sales and accounts receivable testing is, we confirm accounts receivable. That is the single biggest item we do for sales and accounts receivable. Third-party confirmation, as you recall, is one of the most effective forms of audit evidence, and we use that in accounts receivable test work. But we don't confirm every account receivable unless they're all individually significant, which means all material. So we're going to do a sample. How do we determine the sample size? It's based on our internal control test work, our other test of details, and our analytical procedures, and how many errors we expect. So all these factors factor into calculating a sample size, which is the amount of evidence that we need to assure ourselves that our opinion is fairly stated within our acceptable audit risk. Okay, so you can see in this diagram how we audit the different pieces of transactions. You can see that there's a lot of test of controls on sales and accounts receivable, and then cash receipts. But when you look at sales returns and allowances and collections issues, allowance for doubtful accounts, then we're probably going to be testing those with more analytical procedures and test of balances. The one correction I'd make to this slide is we don't really test the ending balance of sales, right? We are testing transactions throughout the year, and that gives us assurance about sales information. We test the balance of accounts receivable, we test the balance of cash because we are verifying those and opining on those as of the date of the financial statements. The sales information is based on the entire operating period. Okay, so we'll go on to chapter 15 and talk more about how we test control.